Matthew.
Good afternoon.
All right, let's get going. So, guys, we're going to be doing a fund update call. We do it every last Wednesday of every month. So today we're going to be going over earnings, particularly of the Magnificent Seven. So, Matthew, let's bring it up. We're going to talk about how our fund is doing, what we see happening in terms of seasonality, and what we see happening in terms of 2026 and beyond, and how we're investing as a result of it.
Absolutely. All right. So let me just pull up the slide deck and we will start. Again, this will be added to um our YouTube channel shortly. And yeah, so I'm just going to go back to the very beginning and we can start from there. All right. So today is November 26th, 2025, and this is our Theta Alpha Fund update for the month. Okay. So today we're going to speak about U.S. earnings season.
Can we do the full screen if you wouldn't mind?
I think it is on the full screen, isn't it?
No, I'm seeing a side screen as well. So,
Okay, hold on a second. Uh, how about now?
there we go.
There you go. Okay. So we're going to talk about U.S. earnings today. U.S. earnings season actually just came to a conclusion pretty much about last week. I know there's TSMC, I think, which is reporting to December, but generally speaking, earnings season is pretty much behind us, and we want to go over that in a little bit more detail, because obviously that affects our decision making as well, right? So let's get into this, guys. In the S&P 500, about 83% of the companies reported a positive EPS surprise, right? So that's a pretty good sign, right? And
Yeah,
we've seen
because
that.
let's just go back. Ultimately, stocks go up or down long term based upon how much a company makes or doesn't make. So when you see 83% of these companies making more earnings per share, surprising. So there's something called the Wall Street consensus, basically what Wall Street thinks is going to happen. So 83% of these companies, which is like, 6 out of 7, I believe, or 5 out of 6, excuse me, they beat on the upside, right? So they surprised. 76% of the companies reported positive revenue surprise. So that's good to see. That means companies are actually quite profitable. Let's get going.
Yeah. All right. So here we see the bright blue line is the price of the stock here, guys, and the dark blue is the 12-month forward. Okay. And you can see it's, when you hear things in the news like, okay, well, prices are, multiples are high. This is kind of the thing that they're reflecting on. Now, that being said, I don't think this is such a terrible thing. Obviously, we don't want to see prices create multiples which are like, crazy out of whack. But at the same token, we do need to be cognizant of this type of data. Oh, anything else on
And
the slide you wanted to talk about?
no, you can see that every time the blue line gets above the black line is the forward 12-month P ratio, 10-year. This is the 10-year chart. And the second one is the price of the S&P 500. So you can see right now we might be a little bit extended. As a result of that, what we're doing is we're hoarding a little bit of cash, but we'll get into that bit later on.
Okay. So earnings season. Okay. So the revenue growth for the S&P 500 is 8.4%. All 11 sectors reported year-over-year growth, all 11 sectors. So pretty strong showing there, right? And the reason we're focusing on the S&P guys is because that's the when people say, "Oh, how's the market doing?" The market typically refers to the S&P index in the absence of mentioning another index, right? So when you hear the word market, usually the S&P is the source that they're talking about. Now, from our fund's perspective, we are more close, our official benchmark is the NASDAQ 100. And, of that, we are fairly concentrated in the Magnificent Seven stocks. So those are kind of our focal point on a daily basis and also in this presentation, right, guys?
Yeah, so
Um,
I was going to say, Matthew, that one of the major downside surprises for the Magnificent was Meta Platforms. You can see their earnings per share was $1.05 versus $6.72. So that's a big negative surprise. So if you take that one out, you'll see some very good earnings growth and earnings upside from.
yeah, that's true. So overall, like 5 out of 7 reported positive EPS surprise, not positive EPS, but positive EPS surprise. The Magnificent Seven companies reported earnings growth of 18.4%, below the average of 28. Now that's a decent decline over the previous 4 quarters, but at the end of the day, it's still a decent number there in terms of earnings growth. Okay, let's continue on here. So here we have a chart. In addition to the 4 companies, Eli Lilly, Uber Technologies, Intel also rank among the top contributors. It does seem that Intel is kind of making this kind of American comeback story. And we see that in the news a little bit. But Eli Lilly and Intel benefited from favorable year-over-year comparisons as prior earnings were impacted by charges and expenses in Q3 2024. Our estimate going forward is that these will kind of continue to accelerate. And estimate calls for earnings growth of between, like, if you look at here, basically about 20% for the next year or so, right? That 18 through to, yeah, is it 18? Yeah, 18.5 up to, like, 24.5. That's about, on average, let's call it like a 22% range there, 21% range there, right? So, or 21% average, I should say, right? So pretty strong growth that is expected. Here we have just how outsized the Magnificent Seven earnings are compared with the other 493 stocks in the index, right? So
the S&P 500 has 500 stocks. Magnificent Seven only represents 7 of them. So you can see here how much more earnings growth the Magnificent Seven is getting compared to the overall S&P 500 if you strip those 7 companies out. It's a substantial difference. So if you look at, let's say, Q4 of this year, you can see the Magnificent Seven is projected to be at 19.8, and the S&P 500, the rest of the companies, are 3.4. So there's a huge gap between what the Magnificent Seven are doing versus the other companies. And I suspect a lot of this is spending on artificial intelligence infrastructure, right? Spending by some companies, and a lot of companies that we invest in are also related in the hardware and the software manufacturing of artificial intelligence. So a lot more growth. So you could be paying a higher multiple for that company, right? But the flip side is the growth is also there. So we want to make sure that growth continues to be there. Let's keep going.
Okay, so let's continue on here. So growth of 7.5%, revenue of 7.3. That's for this current quarter. And you can see here that into Q2 2026, it's 13.3% is expected. Revenue growth of 7.7% is there as well. So these expectations are pretty decent, right? They're pretty decent expectations. Now, granted, they are only good. They're only as good as the assumptions that they're based on, right? But this seems to be quite a positive note going forward. And there has been this debate, especially in the AI field or space, about where's the ROI? Where's the ROI? Who are the end users? And slowly but surely that kind of jigsaw puzzle is being pieced together. So yeah,
I think Matthew, what you mean by that is, like, for example, let's say, for example, Meta spending a lot of money on hardware through NVIDIA and whatnot. What Wall Street wants to know is, are they actually making money? They're spending tons of money buying this stuff and building this infrastructure out, but are they making money doing it? What is the ROI, as Matthew said? What does that return on investment look like? So that's the big question of what's going on right now. So far, it looks pretty good. It looks like there's pretty good ROI. Otherwise, these companies wouldn't keep investing in artificial intelligence. Why would they? But right now,
it's interesting. So IT and consumer discretionary show the highest expected depreciation, 26%. Now that's expected, but then consumer discretionary, 26.4. That's industry. That's interesting. And I'm saying that by comparing that mentally to our consumer staples. So that means that people have money left over to spend on stuff, and that's the downstream effect. Okay, let's continue on here. So we're going to go through basically some of the stocks in our Theta Alpha portfolio to show what they have been doing. So we'll start here with TSMC.
This one's a big one, by the way, because TSMC makes all the chips, not all the chips, but the vast majority of chips for companies like Apple, for companies like Microsoft, companies like Meta, Tesla. It makes the chips. Those companies design the chips, and then NVIDIA and AMD are the ones that also design chips. And then the chip design eventually goes to Taiwan Semiconductor, and they manufacture it. So NVIDIA, for example, doesn't actually make any chips. They just design them. Right? So this one company is very important to look at. And you can see here the revenue here, 33.16 billion, which is above forecast of 32.07. And the company's earnings per share were also higher. The company's revenue increased 30% from a year ago. Net income rose 13.7 from last quarter, and they raised their full year forecast to the mid 30% range, whereas previous was 30%. Now, what this means is that Taiwan Semiconductor has a robust amount of demand, and that demand keeps going up. That demand wouldn't go up if these companies buying this or manufacturing these chips weren't seeing a return on investment. So this one company is extremely important when gauging the overall health of the Magnificent Seven. And it looks like it's so far great.
Yeah, so far this is actually doing quite well. And we will continue to monitor this. The interesting thing is as this is not in the Nasdaq 100, right? It's not one of the constituents there, right?
Yep.
But it is nonetheless one stock which we do have inclusive in our portfolio. Tesla is not the case. Tesla is obviously a stock that is traded on the S&P 500. It is also traded on the Nasdaq 100, and it is something that is in the Theta Alpha portfolio. They did have a bit of an earnings miss. It wasn't the best, right?
The revenue beat on
revenue beat, yeah, 28 billion revenue was higher, but the EPS was not, right?
Now, Tesla is an interesting company. What we're looking for Tesla is we don't, this is all fine and dandy. This is their basically automotive revenue and their energy storage. What we're really looking for Tesla is how quickly can that robotaxi, i.e., the car that drives around by itself, how quickly can that spread around different cities and then become a global phenomenon? Because the revenue and the earnings per share that they'll make from that will be far higher, or potentially could be far higher than the current revenue that they have. So Tesla's a bit of a different story. So as Matthew said, they did miss a bit on the earnings per share, but the revenue was pretty good.
Okay, let's continue on here, guys. Alphabet or Google. Okay. They beat forecasts, 102 billion versus 199. That's good. And 310 versus 233 on the EPS side. So solid showing here. Quite happy about that. And this is the kind of monitoring that, I think, as money managers we need to do. But anyone that's interested in the stock should be doing at least a cursory review of this to see, hey, do I like this or not? Okay, let's continue on. Microsoft we see here, guys. Again, beat earnings, top and bottom line. Top line being revenue, 77 versus 75, and earnings of 272 versus 372 versus 367, right? And
their Azure division, Matthew, grew by 40%, which is the division that we're looking for. So Microsoft, you guys know, does Windows. Windows. It does got Office. It's got Outlook. It's got Xbox, but that's not really where we're looking for growth. What's the growth area for this is their cloud division, which is called Azure. So they're the number one provider of cloud services globally. And to see that growing by 40% when it's such a high margin business, that is very good.
Yeah. Okay. Sorry. This should be actually titled Meta, I think.
I think it's the other. Yeah.
Yeah, Meta Platforms reported revenue of 51 billion versus 49. So that's a good revenue beat, guys. But unfortunately, the earnings came shy. There were some extra expenses. There was a tax charge of $16 billion, and that really adversely affected the earnings per share. That came in at $1.05 versus $6.72 per share. That was expected, right? So obviously that was a miss there. But oftentimes, the investing public wouldn't believe that, or at least I don't believe that this is a recurring theme, that you're not going to have a recurring one-time tax charge of $16 billion, right? Because, it is a one-time tax charge. It's not a recurring tax charge, right? So fundamentally, there's no real change in the business. They did have this tax issue. It has been booked through P&L, and I think from that perspective, the next quarter round, this should not be an issue, and hopefully that tax expense or that provision for taxes would revert back to the effective tax rate that they've had for a while. Okay. Yeah, this is for some reason there's a double meta thing here, but apologies there. Eli Lilly. Again, this is one that is in our portfolio, but not included in the NASDAQ 100. Okay. Eli Lilly trades on the S&P 500. Okay. It beat revenue by over $1 billion and also handsomely beat EPS by 702 per share actual versus 569 per share expected, right? So, we do like that. We do like that type of performance, and this gives us a nice warm and fuzzy feeling about this stock. A little bit more because the price action on this has been, it has been a little bit unforgiving as of late. So this has actually created a nice little uptick in the stock here as well. Okay. Amazon, another beat on both the top and bottom end, 180 versus 177 and 195 versus 157 on revenue and EPS respectively. The cloud segment increased by 20%. Right? These are significant numbers, right? And I'd say anything over 5 to 7% you can kind of term as significant. It's not an exact science, but that's how I would define it. And again, we do see growth. So, we've gone through about half of these and we'll continue to go through them. But like you can see, it is hard. I think you're hard pressed to say, okay, well, where's the softness in earnings? It's like, well, there's not really softness. Like they're still pretty strong, right? They're still coming in pretty strong. Apple, it's interesting at this point, Apple is one of the, obviously it's a large component here. And they're one company that they don't have like incredibly exciting things in store for us, but like it's a nice steady type of technology play, shall we say, if that's not too much of an oxymoron, right? But it came in at 102.47 billion in revenue versus 102.24 expected, and it did eke out the expectations by about 8 cents per share on EPS, right? Now don't forget, like as we know, we've talked about this before, Apple basically sells Apple iPhones to North Americans and Europeans, right? Like that's what they do. That's what
they
do.
got a big market in China as
They
well.
have a big market in China, but I think it's like literally it's like 50% iPhone sales, I think, right?
Yeah,
Somewhere around that vicinity.
Yeah, and what their main area that we want to see them grow is in Apple services, right? Which is the high margin business, which is
Yeah.
things like their, for example, Apple Music, Apple, these type of things. You want to see growth in that area because that's a high margin business, okay?
Yeah. Continue on here. AMD. Again, this is AMD's been actually doing quite well lately. But again, they beat earnings on the top. They beat
By wide
revenue, beat
margin, they beat
earnings.
revenue.
They beat revenue, beat earnings by 4 cents on EPS and by almost $500 million at the top line, right? So
Yeah.
actually a little bit more than $500 million at the top line.
Now, AMD, they play second fiddle to NVIDIA. So NVIDIA is the main chip designer and the main chip, not the manufacturer, but the designer for most of these companies. Now, they have a software called CUDA that goes along with their chips. Now, NVIDIA's demand is higher than that they can supply. So, and the cost is also pretty high. So oftentimes some companies, what they're doing is they're now leaning on AMD to pick up that slack. And AMD's traditionally has been a great second fiddle. They played second fiddle to Intel for a long time, and now they're playing second fiddle to NVIDIA, which is the most valuable company in the world. And as you can see, they're doing quite well at that. They're chipping away at NVIDIA's market share. So we expect some really good things out of AMD over the next number of quarters. And you can see they're implying a revenue growth of 25% for the fourth quarter, which is fantastic.
Okay. Constellation, again, one of those companies that it is connected to AI, guys, right? There's a linkage there, but it is not in the Nasdaq 100, and they have other non-AI businesses, right? Obviously, right? It is an energy company, right? And they recorded earnings of 3.04 per share, above expectations of $3.11 below. Sorry, it's below expectations of $3.11. So slight miss there. But the revenue beat 6.57 billion versus 6.2 billion, right? So they
Yeah.
definitely beat on revenue there. And you can't expect this is at the end of the day, this is an energy company. You can't expect crazy amounts of variability in their earnings either, right? Because it's simply a different business. Okay.
Yeah, no, exactly. Why would we be buying an energy company? That doesn't make sense. Well, it does because all these data centers that are being built out to run artificial intelligence, to train the models, they require immense amount of energy. And we think Constellation Energy is very well positioned to provide that energy to run these data centers, to train these models, to train artificial intelligence over the next number of years. So that's exactly why we're buying Constellation. We expect some pretty big things out of Constellation over the next number of years.
Okay, let's continue on here. NVIDIA report earnings for Q3 26 and beat revenue and at the earnings level as well, right? So again, like you can see there's a common theme, right? And this has a lot of we've gone through these, and I think this is the last one. But the common theme is technology or technology related, likely directly in the AI space or very close neighbors to the AI space, and they're beating on both top and bottom line, right? So there is that theme there, and there are people that saying this is a bubble and it is going to burst. And I would say that I think there's a big difference between bursting and correcting, right? A burst is not, a burst implies that there's nothing inside the bubble, right? I believe the bubble is actually filled with certain amount of, you know, solid foundational earnings and revenues and real things that people want to buy and sell. So I don't think it's necessarily a bubble, but is a correction in the mix here? Yeah, absolutely, it could be. Absolutely. And maybe we're in one now. This is November the 26th. And we've had a very rocky November, right? The market's down what, like 6% to month to date, something like that, Omar? It's been,
Approximately, yeah.
yeah, it's been a
Maybe a
rocky
little less than
November.
that,
Is
but
this
yeah.
is this the correction? I don't know. Maybe it is, maybe it's not. Although I think a correction is officially 10%. Is it 10%, Omar? The
Yeah,
official?
10% is considered a correction. That's correct.
Yeah, okay, well, fair
So
enough.
not an official correction, but if you get a 6% retracement in 1 month, it's significant, right?
Yeah, it's something of significance, right? Absolutely, right? And these terms are just defined by people in the industry, right? They're not like written in stone. Um, okay, S&P 500. Here, speaking of corrections, you can see that, the month of November, and this is pretty interesting, guys. Um, on another call I did, I remember the last time the market went down, like as a negative return in the month of November, was actually November of 2008. It's a long time ago. There's also happened to be, quite right in the middle of a global financial crisis. Okay, so is that really a good data point? Maybe, maybe not. But it has been quite a while since November was indeed negative, right? Like even in 2022, I think it eked out just a small little gain, right? And you
Yeah.
can see here that, yeah, there's a certain amount of downward momentum that's happening here, and we can see if it can pick back up again. And here we see a very similar chart, but with kind of more aggressive ups and downs. And yeah, you kind of see that there on the Nasdaq as well. Okay. Let's continue on here. So in terms of our alpha fund, here we have our holdings, about 14 odd holdings. And our Alphabet at 9%, Amazon at 8, Apple at 3.6, et cetera, et cetera. Driving our returns one way or another will be Microsoft, Tesla, Nvidia, Meta,
Yeah.
right? And to a slightly lesser extent, um, you know, Google, Tesla, and Bitcoin, right? So we do see here that yeah, we are outsized weightings on certain positions, right? But we believe in our conviction remains still solid on these stocks. Yeah, do we need to watch them? Yeah, absolutely. Do we expect them to go gangbusters like tomorrow or the day after? Absolutely not. But we do expect these stocks and the sectors in which they operate to do very well over a period of time, right? So this investment product isn't one that you jump in and out of on a daily basis. This is a longer term, higher, I wouldn't say higher risk, let's say a higher price variability type of portfolio, which we've positioned very carefully and we manage actually every single day. So yeah, this is now we have had, we're trying to. You may say, okay, well, what the heck is this XQQ thing in there, right? And one thing which we are managing for is a little bit of currency risk, right? Because all these stocks are in US dollars, guys, and we report back in Canadian. So we do have a little bit of currency risk there. And sometimes sometimes not a little currency risk, sometimes it's a lot of currency risk, right? So as a little bit of a hedge to start off with, we've introduced XQQ, which is the Nasdaq 100, but it's hedged back to the Canadian dollar, so that acts as a little bit of a hedge for us. And we're
Meaning, when we buy like Nvidia or Taiwan Semiconductor or Tesla, we're buying that in US dollars, but people are investing in Canadian dollars. So what we do is we hedge out that, meaning we make it so the currency is not as relevant. So what we're doing here when we're buying this XQQ is we're simply trying to participate in the market. So instead of holding, entirely cash, we're holding a little bit of XQQ, but it's hedged out. So it's a good spot to be in.
okay. Um, so we have about 1% of our AUM is in short put exposure. Okay. Meaning if we were to be assigned every put like as of this date, which is like 2 days ago, that'll account for about 1% of the portfolio. Mostly long stocks at about 91%. We do have a chunky cash reserve, guys. 7.4% is a chunky cash reserve. So we are ready. If there's like a 3, 5, 10% downfall in any one day, we're pretty decently
Or over a
capitalized
period
to
of
take
time as well,
advantage of
Matthew.
that.
I was going to say over a period of time too. If there's a pullback over a period of time, we've got some good cash on hand.
Yeah.
Now, the thing is, traditionally speaking, the November to January period, as we're going to about to see here, is the most favorable period of the year when it comes to the stock market, right? So, but because September and October were pretty good, and normally they're not very good, we want to take that into account, have a good, nice cash position in. As you can see from that earlier chart, it looks like we're a little bit above, maybe where we should be, and there's a decent chance of pullback. That's why we're holding a bit of cash. You can see our year-to-date return of 18.31%. That is net of all fees versus the Nasdaq in Canadian dollars, which is our benchmark, at 16.54. Now, that is very important because most funds do not beat the benchmark, the index. We are beating the index, and that's exactly the goal that we want to have and
Yeah,
execute.
so far doing very well as of a couple of days ago. So,
Yep.
again, this is a portfolio like it's nice to beat the benchmark on a daily basis, on a monthly basis, or a yearly basis. But what really matters is if the benchmark is being beaten, over a 3, 5 year time horizon, right? And that's when it really, really counts. And obviously that,
Yeah.
a journey of 1,000 steps starts today. What have you? A journey of 1,000 miles starts with a single step. Yeah, so we're at the beginning of those single steps in rounding out year 2 here. We're quite happy so far, and we're gonna make sure this continues, or do our best efforts to make sure this continues, right? Okay, so there's a few details about the fund that you probably know about. It is RSP eligible. Our management fee is 2.5. The fund serve code there is CCI 705. It is considered a higher risk portfolio, guys, just because of the sectors we are in, the allocations we have, and the price variability attached or associated with those underlying stocks. So yeah, you do need a little bit of a long-term time horizon, because it is for the growth investor, right? That's it. So what are we looking out for next? November, December, January, historically the best 3 months. Let's hope so. Let's hope
Yep.
so. November to January, 4.4%.
Yeah.
Um,
That's 3 months. So, right. But you might be asking, well, why are we holding so much cash then? Well, again, we had some like September, October are generally not very good periods of time. So you look at October, so that August, October, or sorry, so August, September, and October, 0.1%. That actually did very well this year. And like I said, we're maybe a little bit that chart we looked at earlier on with the blue line and the black line, when you can see the earnings per share and the price of the S&P 500, we may be a little bit overvalued. So we are holding some cash, regardless of this being a very favorable time of the year. Okay.
okay. So historical December has been a positive month, guys, but not by much, right? Average of 0.6%. And you can see here in the chart, 65% of the time there's a gain. That's actually not bad odds to kind of bet on. But like that being said, look how often November's been higher. 75%. Just not this December. Sorry, November. 75% of the time, November has been positive, just simply, well, I shouldn't say not this December because technically speaking, there's two more trading days. But yeah, but one of them is closed tomorrow for the holiday. So unless there's in the States, I'm saying in the States. So unless there's a giant rally on Friday, chances are it's going to be a negative month today, negative month for November. Okay. All right. And you can see here, the minimum return was a negative 7.5. When was that? In 2008 here, guys. Okay. So if you're interested in the fund, please call Omar or myself, or David Jarvis. Our contact information is right here. And yeah, Omar is the dealing representative. David and I both portfolio managers on the fund. And give us a call if you have any questions. There's our mandatory disclaimer, guys, as we are working in a regulated industry, and we want to obviously abide by all their standards. We'll leave this on for a little bit, and yeah, let us know if you have any questions. Okay, thank you, guys.
Thank you, guys.